Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, March 15th, 2023. It's 12:15 Eastern Time. I figured I'd do another video with the markets moving. Really, since this morning, they're kind of in a holding pattern. I don't want to say surprisingly. We are down. We've been down all day. We're red, but let me do this. This is what the site's all about. I'm going to go over some additional trade ideas. The markets, if you're trading the indexes, whether you're actively trading or position trading with a swing or trend trade, um, they should only be one of various positions in a portfolio. So I'm going to give you some other ideas, individual stocks, and I'll try to hit on. I already covered gold and silver quite a bit today. Give you my thoughts there, but let's cover some of the other stuff. And if you recall a few weeks back, well, let me just do a quick update on the long-term charts, kind of bigger picture stuff. If we do take out the recent lows, remember, for this party to really get started, in my opinion, we need to take out the lows from Monday right there, that red. So just to kind of recap, if you haven't caught up on any of the videos lately, breakdown of the primary trend line, the 200-day moving average back test, and a rejection. But we're still above that low right there. Pivot lows like that are always an important low for traders. There's a call it an invisible hand, whatever you want, hold the markets up today. My thoughts are, my guess is, this we're coming off the longest and probably strongest bull market in history. The Fed since 2008. The Fed has absolutely refused to allow any corrections in the market. As soon as the market started to even show signs of rolling over, the last big one was other than COVID. We know what happened. They came in with the what I call the all-out nuclear response at that, and interrupted what would have been a much longer bear market and deeper bear market. And then before that, it was the fourth quarter of 2018. The same thing was happening. The Fed started after years, a decade at that point, a decade of near zero interest rates, too low, way too low for way too long. They figured they'd start to, rein them in, bring them up a little, give them a little more room for the next crisis. Well, as I predicted at the time, go back in those posts, I said the Fed will pull a 180. And the market will turn around. They did exactly that right into the December lows on that correction. Market exploded because then they started cutting rates again and brought them back down. And so that's I think what them is in the mindset. It's ingrained. I mean, it's like Pavlov's dogs. He fed him, he'd feed him, and he'd ring the bell. He'd feed him, and he'd ring the bell. He did that long enough, and then it's conditioned stimulus and a conditioned response. And then all he had to do was ring the bell, and the dog started salivating, even if there was no food there. So, dip buyers, it's human nature. That's buy dips. Or if there's a financial crisis, that's an opportunity, not a problem for the market. It's an opportunity. Again, I'm telling you what the collective mindset is. It's an opportunity because no matter how ugly the situation is, how bad the technicals, how bad the fundamentals, the Fed's going to do something. And I've said this many times, they do not have the dry powder that they used to. So, and I think what little powder they have, there's always some kind of type of shenanigans they can pull. But I think they're going to be a little more judicious at this point. So, again, at the end of the day, we can sit there all day long, go back and forth on what may or may not happen. We'll just trade the technicals. Right now, we're still below there, and as such, I view any bounce back like today, for example. If you have a little dry powder, you look at the short-term charts, or let me go to the futures. This bounce back, this is just a short-term, a 15-minute chart, meaning 15-minute candles, 3 weeks of price history. And you can see right here, this is a nice level. See, it capped the rallies. That's resistance. Resistance once broken, boom, an explosive move higher. You come back test, support once broken. You didn't just meander around, you went down hard. And so this is a well-defined resistance level and a very objective shorting level. It may cap today's rally, in my opinion. If that doesn't do it, there's your next short, really good level right there, about 12,369. This one, by the way, is 12,279. I know these colors don't can't make them any brighter or bigger than that on this chart, but that's we'll call it 12,280. So there it is. I think the right now, as I'm doing this video, that's why I started here. There's your objective shorting op or add-on, and then of course take out the recent lows, and then that's good night stock market in my opinion. But we'll see what happens. All right, other things to look at. We know what's going on with the VIX. That one again, your most objective entry or re-entry was yesterday on that back test. Covered it this morning. Again, congrats to those that caught it, and look where we're at, and that's where we're at, the arrow break going up here. And as I said, we've already hit that level now twice, that 239.40 target. So tap, tap, tap. Odds are the more you tap on it, sooner or later it's going to break. And if you bust out of there, that's probably going to coincide with a move down towards or a break below today's lows, and should set the VIX even higher. Do you buy it there? I don't know. Again, there can be some type of market stick save here coming in at any point in time, and you also have some pretty big divergences. Again, it may explode if it takes that level out and run up through there and take these divergences out, but it's pretty stretched. Again, if you didn't buy it yesterday at support, that's the most objective. Why would you want to buy it 20% higher? That's my thoughts. So anywho, we'll watch that, and when I cover it, it just it will help, may help indicate where the market's going if we break out of there, especially if the market breaks the Monday's lows, and that's kind of near-term stuff. Let's see, the VIX has been there a little while. I have this chart, which is a delayed chart, but only by 15 minutes. That one I was just showing you was live, so that's really, this is here right now, or roughly. We were looking at the futures a minute ago. This is the spot VIX, of course, and there it is. So, and that was also highlighted. That was yesterday's pullback, but it was also highlighted right here as an objective entry recently, and that's that move has already been from the back test to that primary uptrend line, to, again, this is where we're at right now with the delay, about a 70% run in the VIX. And I know that sounds like a lot, but that's what the VIX does when it finally breaks out. That was a 81% run. This one back here was a 130% run, and so forth. So that's, again, just the VIX, when it wants to run, it can and will run. That's the bottom line. And it runs into high double and quite often triple digits in short order when it breaks out. And then when it does break out, those have been associated with all the legs down in the bear market since the bear market began. So again, simple stuff. I've gone over that quite a bit. I went over yesterday the Apple VIX, Apple having its own VIX, and Apple holding up. They were buying the tech stocks today. As I said, that's where I think people think there's safety just because this isn't their problem. The banking system, they don't they're not chock full of treasuries that they're hiding market. They don't have to maintain reserve ratios and all that stuff. But again, 2008, with that financial crisis, it really started with the housing market, but it was a credit bubble pop. Was that Apple's problem? No. Did Apple drop 60-70%? Yes. Amazon, Facebook back then, now Meta, wasn't tech's problem back then right away with the credit bubble popping and all the shenanigans going on with the banks and the housing market, but it was because they are the biggest components of the S&P 500 and NASDAQ 100. And when stocks go down and there's forced selling, the financials brought the S&P down, and then when there's forced selling in margin calls, especially at the end of a prolonged bull market, everything gets sold. And no matter how good the fundamentals are, you might love your Apple, but when you were chock full on margin, but in 2007, thinking the market would only go up forever, and it starts dropping 20, then 30, then 40%, you might scream and yell at your broker, hey, leave my Apple alone, but they're going to sell it. It's called a margin call if you don't have, can't come up with additional funds. And that's what happens. That's why I'm just trying to explain why good companies go down, even if their fundamentals are good. in a bear market. So, all right, I don't want to get ahead of myself. Like I said, we're still in close proximity to the 200s. And, if the market wants to pull a stick save, I can say now's a good time to do it. Where it gets a big red a big green candlestick back up solidly above there. But I wouldn't bet on it. In fact, I'm betting the other way. So let's not beat a dead horse. Let me show you some other trade ideas. All right, I'm going to start here with the industrials. XLI is the industrial sector ETF. Back about a month or so ago, I started using that pun off Seinfeld, what I said, bear marketus for the rest of us, kind of playing off that whole Festivus for the rest of us holiday thing that George Costanza came up with, saying that there are a lot of companies that were trading at or near all-time highs, their previous bull market and all-time highs, including and not limited to the industrials. So the market snipers, the bear market snipers, will go out and start one by one, and that's what they did. It was a one by one kind of thing, stock by stock, sector by sector, starting with healthcare was one of them. XLV I mentioned, that one was at right here recently when I was talking about it, near all-time highs, had a bearish rising wedge, and I said, we've had three breakouts above this trading range. All three occurred with negative divergent highs, which gave it a very high chance that the breakout would fail. And as I said back then, the MOs, once you fail the breakout above the trading range, your next stop is usually the bottom of the trading range. That's where we are, and that is exactly what I'm talking about, where the market went out, found those stocks that didn't get the memo, hey guys, we're in a bear market. And there's the healthcare, a normally defensive sector that should go up or hold its own during a recession. And now bigger picture is we're back to the bottom of the range. Now, yes, given we've had two false breakouts to the bottom, and that sent us back up towards the top. But, when you go, and that's what I'm going to do here, is go to the longer term charts, look at bigger picture. Remember, we're coming off one of the longest and strongest and most overdone bull markets in history, a la the Fed and a la easy money. In other words, the market stocks typically go up most of the time, but every now and then they have corrections. Corrections are natural and needed and healthy. But when you have excessively low interest rates for an extended period of time, it creates a lot of ultimately creates a lot of problems in the system. And again, it's simple. No trend lasts forever. And the bigger the trend, the higher they rise, the harder they fall usually. So healthcare, my point is that healthcare has a good chance, and I would say a very high chance before the bear market's said and done, of taking out the recent trading range, especially as it broke this primary uptrend line, which it broke back in when COVID hit. And as I said, COVID was, although considered by many a black swan event, and I'll recognize that as it was, but it was also a bear market was priced in on just about every index and sector, with divergences on the weekly chart, sell signals that came before it. And COVID sort of accelerated, in my opinion, the downside, and then the federal government and the Federal Reserve truncated that bear market instead of letting it run its natural course, which probably would have done this and purged out a lot of the excesses, and we'd probably be on much firmer footing right now than we are. So anywho, I wanted to cover that now. That's not one of my favorite sectors to short, despite like I said, most of the meat's been sheared off that bone. There was your sell signal back there, and there was the move, and now we're at support. If anything, you want to be buying this one. But the other one I wanted to point out is the industrials. And just last night, as I was pouring over the charts, and please give me a reply in the comment section if you've experienced this. TC2000 has a feature I love, and I use it daily. I depend on it. It's one of my favorite features, and that's a component watch list. You click this little thing, and I usually have it when I do these videos. Every chart I load, if I enter an ETF, it's going to give me all the components or a sector. The index itself, like SPY, QQQ. You type in QQQ, pull the chart, and I get all 100 components. I can sort them, which I usually do by market cap, by percentage gainer or losers. But since last night it's not working, I emailed them, no response. It would be very helpful to have that today. So what I'm going to do instead, first let me just cover the chart itself. And again, this is one of the sectors recently trading at all-time highs, kind of not getting the memo about it being a bear market and a recession coming. And but recently you can see we had just a mountain of evidence to get short the industrials. And we did. And I threw out some of these as individual trade ideas, CAT being one of them. I gave you an update last night, and that's where I was starting to go over the components. Clean, clear negative divergence, a very clean uptrend line. These two, the purple lines that I'm overlining in blue or overlapping in blue right here, that shows the bearish rising wedge. There's the breakdown, back test if you missed it, and then look, just nice fall. We just took out a big level. That line right there, about 97.80, was the bottom of this box here, this trading range. It was really a topping pattern. And so this is one of my favorites. A lot of individual components, but what I have to do right now is type in, there is a go around for TC2000. Just pull up one of the sectors, like you go in here at industrials, SX100, you could maybe, well no, that's the Dow 30. They usually have the these IX 2190. So if you comb through there, that's one good thing, is they have a lot of other sectors. And this one does load up. You can see here, boom, there's all your components right there. I like to sort them by market cap usually, and that shows you the big ones first. The reason I do that, if I'm trying to get a good feel for a sector, you know, and I'm looking, just going through it in random orders, some of the bottom components might have such a small weighting that no matter how bearish or bullish their charts are, then it's not going to move the needle. But when you go by market cap, most sectors and indexes are market cap weighted, meaning the bigger companies have a higher weighting. So there's UPS at 157.6 billion, RTX, Honeywell. So that's what I'll do here. And I already have the list. Well, I'll just go through this one here like this. All right, I'm going to just rifle through these in no particular order. And there's one I want to share for you that's down here, and that's GE. I'll get to that in 1 second and then give props. One of the subscribers on the site mentioned it the other day, and I took that one. I said I would share it with you guys. I meant to do that yesterday. My bad, it kind of broke down today, gave a sell signal, but it's not too late. I'll get to that in a second. So here's UPS, pretty much walking its way down. Here's a downtrend line. And if you were to short this, one thing you can do is short rallies into the trend line. And then right above that, that's my BOD, benefit of the doubt resistance level. It was a good level. Let me move this. It was about 190. Lots and lots and lots of reactions. So it was bearish when it took out 190. It's been consolidating under it since, so it has dual resistance levels above. Now, given a break above there is bullish, so that's where your stops should be, somewhere in there. Not one of my favorites, I will say that, but one that you could short, one that's probably going back down here. And especially when I get to the weekly charts, I'll show you some of those. Really tell me where these stocks are going, not tomorrow, next week, but over the next year or two. And in most cases there's a lot of downside. Maybe I'll just toggle to some of these and show you the weekly charts. Yeah, I don't have a lot on UPS. RTX, you can see there's your uptrend line, big wedge here on this weekly chart. I just have to extend that divergence line. See, last time I would have updated this was right here. I had divergence. Last night I may have extended that line, and it's not as if that divergence didn't play out. It wasn't the top, but it was a top. It was good for a 23% short trade or pullback. And then we went on and made what I refer to as a marginal new high, ever so slightly higher high, and then a reversal. And it simply made even a larger divergence, just extend the divergence lines. So now when you break the primary uptrend line, this one's headed to right here. I put very good odds, minimum right there, but this is my preferred target right there. That's right at about $80. Let's round it up. And maybe at one point in the near future I'll revisit that if we hit that 80 level. And that's still good for a drop of 16%. Honeywell, let me go to the daily. I can't do each and every one. It's going to take forever. There's a lot of components here. But you can see, put in a divergent high recently, moving lower, coming up on support, not one of my favorites. I'll be honest with you, I haven't culled through this list yet. I just wanted to kind of give you an overview. When I say haven't culled through it, I mean to highlight and set aside my top picks, but I got a couple here. Here's Boeing, T3, I guess I already covered this one. Is the first of the intersecting downtrend line and or 173. Okay, yeah, so I threw this one out, I guess, back here, and all it did from that point is made a marginal new slight new high. Wouldn't have stopped out if you're going through T3. So back then, whenever that was, I laid out 3 targets and said that T3 would be the first of the intersecting downtrend line and or 173.13ish support. So that's right here, and that's still in place. So there's if you're already short that one from before, or if you want to short it now, I see about another 10.5%. Might be prudent to wait and see for the recent lows, Monday's lows in the market to go. This one's also poking its nose just below that 196.40, and that's the first target, which was already hit once, and we had a reaction. And the way my targets typically work, I expect a reaction on the initial tag. You can have subsequent reaction, and you did. You had another bounce off the second tag, and now we're taking it out. So that's probably going to move on down through there. But we're close enough that they could stick save it by the end of the day. That means that candlestick prints back on or above the line before the close, or by the close. UNP railroads are about to come off the tracks, in my opinion. Big support right here. And on a weekly chart, there it is. This is really what you want to look at here. This is nice. That's the same level, about 189. Once that goes, I don't see really a whole lot stopping this stock till it gets down to 125. Sure, I mean, it's not going to go straight there. There'll be some zigs and zags along the way, but that's a 34% drop. John Deere, nice bearish rising wedge on the weekly. When I go out to these weeklies, I'm not talking day trades here, or 3-week trades. I'm talking position trades that'll last months and sometimes even a year or more. And this one I expect to hit 326.75, give or take, have a reaction most likely, unless the market's melting down, and then work its way down here. Ultimately, my preferred, I'll call it my preferred bear market target before all said and done, is at least that 171 level right there. That would give you a profit of about 55% on Deere if you shorted it. Cat, I went over this one last night. That was one I laid out and took the time to put on the home, front page post with screenshots. We shorted it somewhere in here on the break. The wedge, we hit T1, T2 just the other day, had a reaction. As I said, it would look like it was bear flagging. You could see it on the 60-minute chart I mentioned. I didn't give that to you last night. I just said take a look at the 60. You'll see that bear flag. And that's what happened. There was your bear flag. Bear flag consists of 3 components. A flagpole, which is a very almost a unidirectional sharp drop. That's your flagpole, followed by an area of consolidation, which occurs on declining volume, which what you have. Here's my volume bars. And then your sell signal is the break below the flag. And that gives you take then the measured target for the pattern is just take a trend line, measure the flagpole, and just take that. You can either duplicate it or just drag the whole line, put it at the top of the flag, not the bottom, at the highest point of the flag, and that's your measured target for the move. So that would take us down to 204.64. But yet I have next target coming up at 210.98, then 199.30, and then moonshot target here if you want to either game the counter trend bounces or just hold out for 162.10. That's my preferred, what I'm going to call my preferred bear market target, and it's right there. That comes in, and that's a big level too. That's your primary bull market uptrend line. So from this aspect, really, that would just be a bull market, a correction in an ongoing bull market. If things get ugly in this bear market, which I can easily see the possibility of, I just didn't want to put this last night. I'm sure it would freak a lot of people out, thinking I'm crazy, but this stock could easily go down there to that 120 level. That'd be a pretty ugly bear market, which we could be coming up on. So anyways, that'd be a drop of another 50% from where we're at today, after the drop we've already had. But again, I don't see on the weekly, that target's a magnet for me. It's what I call a high probability target. I think there's a good chance of that being hit. So I don't tell anyone what to do. I'm not a big options trader. I've played with them a lot of experience, but I prefer shares. With options, I always say this. The reason I'm not a big fan of options, I do a pretty good job of having my top price targets hit. I'm not perfect, but with stocks or shares, you just have to be right on where the stock is going. With options, not only do you have to be right on where it's going, but when it's going to get there. Because I've had plenty of puts and calls that expired just too early, only to see the underlying go on to hit where I thought it was going to go. I was just it took a little longer than expected. Now you can buy that time, but you're going to pay for it in premium. So anywho, that's my thing. Alrighty, and then last but not least, I'm not going to go over anymore. GE. All right, so this was, if you go to the site, come to the site, you can use this little search bar and go here, GE. I told you it was mentioned by a subscriber under the comment section. So I type in GE, it's going to load anything here from homepage post, but it wasn't on our homepage post, it was in a post comment section. So here it is. So this was, and then it will take you to that part automatically. Member trade 0039, GE looks like a good short candidate. And so there it is. There's the chart. I said it was one of my, I said beautiful setup. I said I'll share it. Nice. Well, let me go to the live chart, but there it was. I said sell signal would come on a break below this bearish rising wedge, which would also be a failed breakout of that key 90 resistance level. So what you had here is a triple top, 1, 2, 3, perfect tags of that level. Then we just gapped above it. I love these trades because we all see what we want to see. Bulls that are wearing bull goggles see a breakout to new all-time highs. Stock with tremendous relative strength, meaning we're in a bear market and GE just went to new all-time highs, and so they gobble it up. That's technically a very bullish thing when a stock breaks out to all-time highs. The reason for that is when a stock breaks out to all-time highs, there are zero. Nobody is underwater. Everybody's positive, so you don't have any remorseful trapped longs just dying to get out. However, we all see what we want to see. What I see is a breakout that is very likely to fail because you're extremely overbought. Look at the run just to get up there. That's a lot of spent fuel to get to the breakout point. I would like that breakout if I saw it consolidate under there for a few months. You work off the overbought conditions, get the RSI down lower, and then build up the energy for a lasting breakout. But when I see breakouts that are overextended with negative divergence, I'll short those all day long. A lot of times I'll even take them on the breakout in anticipation it'll fail. But in this case, that was the breakdown point 90. So let me show you the live chart and then we'll wrap this video up. So and you can see that there's that 1, 2, 3 on the daily I showed you. This is a weekly chart. It was not only triple top resistance there, it was also resistance back here all the way back in 2018, and it's more of a resistance zone. And so anywho, we failed that, and then look, if I draw it here, we also have big negative divergence on this weekly chart as well with this marginal new high now. So this one, for the time being, I'm tucking it away, but let me give you, which I already did, the targets I already laid out. So there's the breakdown today. We broke down this morning, and it's not like it ran away or gapped down. It broke down early this morning, right out shortly after the open. It's just been moving lower since, and it's still an objective entry. There's plenty of meat left on the bone. You can see my targets right here: 84.70, 80.56, 75.16, and 68.85. Remember, these are the actual support levels where a reaction is likely upon the initial tag. As always, on a short trade, I will set my buy to cover limit orders just slightly above the actual support level that I'm targeting, or support levels. That means some people, everyone's different. Some people will take partial profits as targets are hit, let the rest ride. Some people will game the and I can't tell you right now which ones to game, if they're worth it. Only if and when it gets to each support level can I assess the charts. And what do I see? Do I see divergences? Do I see a potential selling climax with volume? Do I see a bullish reversal candlestick pattern or candlestick itself? Do I see the sector, in this case the industrials, coming up on support at the same time, or is the sector just break key support, in which case G will probably blast right through these? So there's a myriad of factors to determine when to game a bounce, but I can just say that with pretty strong conviction, if the market does break down, clearly takes out Monday's lows, and we start having a pretty hard sell-off, and it looks good, then I wouldn't bother covering at that first one. I would at minimum hold out to this 80.56. before trying to game the first bounce. And if you're a long-term swinger trend trader, you can just, if you get profitable, set your stop at a little above there or at break even, especially when you get down to these targets, and then periodically lower them and just let it run. Go for the prize, the final target. Okay, I'm going to wrap it up here, and I'll continue to go through these the components of the industrials. And again, think of it this way: maybe the market and the economy pulls a rabbit out of its hat, and somehow we avert a recession. But I think it's safe to say that the whole narrative, or that whole the Fed may engineer a soft landing thing, which the market was rallying on recently, that they might just pull that trick off. I think that those odds have gone down considerably lately. At least they have, in my opinion. And if that's the case, then sectors such as industrials, these are cyclical companies, meaning they do well in a economic expansion, growing economy. Companies like John Deere, think about it. There's Caterpillar, construction is going on, buildings are being built, they need front loaders and backhoes and all that stuff. And in a recession, they suffer. Orders get canceled, orders slow down, and that's it. So these are, if you believe that we're going to head into recession, then these are the kind of things, especially those that are coming off all-time highs recently, you got a lot more to fall than some of the other companies, like the banks, for example. The government's going to backstop the banks. They already have. And not to say that there aren't going to be more failures. I almost guarantee you there will be quite a bit more failures. But again, I like to short things that have, or go long trades, either way, that have the most meat on the bone. And so that's what I'm highlighting here for you. Okay, and as I wrap this video up, again, let me just say it bears repeating. I know I often say this over and over, but anything can happen. I always say just about anything in the market is possible. I speak in probabilities. Right now, the probability, in my opinion, favors a move down. But until we take out this low, and then you see a pretty big low here. I'm sorry if I didn't say what I went to. I went to the SPY 60-minute chart, hourly chart. But this is a big level to me, and that's, I'm going to round it up, 394 right there. I see a lot of reactions. I look at the volume price histogram, big level there. You have the primary downtrend line, then that little spike that we made through it, and we were rejected. So this is a level. If you want to keep tight stops, you really don't want to see the S&P 500 go much above there if you're short. You can, of course, give it a more liberal stop, and I still think that'll pan out, meaning if we happen to pop it and run up and test the downtrend line again. Remember, we've already been rejected off the downtrend line. This is just a short term, the downtrend line from late January, early February. We've had several rejections. It's still resistance. That would be a more liberal stop somewhere above there, maybe above that 408 level. Likewise, if we move lower, which I'm leaning towards, a little surprised to see how much we've been holding up today so far. I have to say that. Give the market some props right there. It's that the sellers, the buyers aren't panicking and selling out despite what's going on with the overseas banks and Credit Suisse and all those. And then pretty good support right below that at about 377. So the way I view it, those are just additional check marks. Break below that recent low, and then a break below 377. For me, would be additional check marks that would increase the odds that we're going to go much lower and get that, maybe another surge up in the VIX. Otherwise, if they can hold it here and do this, that VIX is going to melt down like a hot knife through butter. So just be careful if you're in that one as well. All right, I will wrap it up here. This has been Randy Finney with the Right Side of the Chart. Have a great day.